There is a specific kind of silence that falls over a room when a fortune disappears in seconds. It is not a quiet silence. It is a heavy, suffocating silence. It is the sound of thousands of people around the world holding their breath at the exact same moment. Yesterday, on Friday, January 30th, 2026, we heard that silence. We felt the air leave the room. You looked at your screen expecting to see the continuation of the historic rally we have been enjoying. You expected to see green candles pushing higher, confirming your genius, confirming your thesis. Instead, you saw a red line, a vertical jagged scar tearing through the chart. It didn't look like a trade. It didn't look like a human decision. It looked like a glitch. It looked like someone pulled the plug on the global financial system. In a matter of minutes, silver, gold, cryptocurrencies, and equities all decided to jump off a cliff together. If you are watching this, you are probably feeling one of two things. You are either terrified because you bought the top and you are staring at a loss that makes your stomach turn, or you are confused because you know the fundamentals haven't changed. You know the debt is still there. You know the shortage is real, and yet the price is telling you that you are wrong. Today we are going to break this silence. We are going to step into the wreckage of this flash crash and perform an autopsy. We are not just going to look at the what, we are going to look at the why. Because what happened yesterday was not a market correction. It was a structural failure. It was a glimpse into the dark heart of modern finance, where machines, not men, decide the value of your labor. We are going to discuss the rumor that is terrifying the insiders, the rumor of a major government mint-halting sales. We are going to dissect the anatomy of an algorithmic liquidation cascade. And we are going to talk about how to survive in a world where the price on the screen has become a weapon used against you. To understand this crash, you have to understand that we no longer live in a market of buyers and sellers. We live in a market of equations. We live in a market where 90% of the volume is generated by high-frequency trading algorithms. These are not investors. They do not care about the geopolitical situation. They do not care about the supply deficit in silver. They do not care about the solar panel industry. They care about one thing, volatility. They are programmed to detect instability. When the price of an asset moves too fast in one direction, these algorithms switch from greed to fear in a microsecond. Yesterday, we hit a volatility threshold. The rally in silver had become parabolic. It had gone vertical. To a human, this looks exciting. To a risk management algorithm, this looks like a threat. When the price ticked down just a fraction, likely due to a minor profit-taking order, it triggered a logic gate in a massive hedge fund's computer. That computer instantly sold thousands of contracts to neutralize its risk. This sale pushed the price down further, which triggered the logic gate in the next computer, and the next, and the next. It became a feedback loop, a digital scream echoing through the fiber optic cables between New York, London, and Chicago. This is why everything fell at once. It wasn't that investors suddenly hated silver, gold, and Bitcoin simultaneously. It was that the risk parity funds, the massive pools of capital that balance risk across all asset classes, were forced to deleverage everything. When volatility spikes, they sell everything. They sell the winners to pay for the losers. They sell the liquid assets to cover the illiquid ones. Silver, being one of the most volatile and liquid assets on Earth, became the victim of its own success. It was sold not because it was worthless, but because it was the only thing that could be sold fast enough to satisfy the margin calls. But there is a darker shadow hanging over this flash crash. A rumor that began circulating in the private chat rooms of bullion dealers and high net worth investors late last night. It is a rumor that I want you to treat with caution, but also with extreme seriousness. There is talk that a major Western government mint, one of the pillars of the physical silver market, is preparing to suspend sales within the next 24 to 48 hours. Now, why would a mint stop selling when demand is at an all-time high? It's counterintuitive. A business exists to sell products. If people are lining up to buy silver eagles or maples, the mint should be running overtime. But a government mint is not a normal business. It is a bureaucracy, and it is dependent on a supply chain of planchets, the blank silver discs that are stamped into coins. If the mint runs out of blanks, they cannot produce coins. If this rumor is true, and again, we are watching this closely, it means the physical shortage has moved up the chain. It means the refiners cannot supply the mints fast enough. If a major mint announces a halt in sales on Monday morning, what do you think happens to the price? The paper price might be crashing, but the physical price will disconnect completely. The premiums will skyrocket. If you cannot get coins from the source, the secondary market becomes the only market. And in the secondary market, the price is whatever the holder says it is. This brings us to the terrifying concept of cash settlement. This is the phrase that keeps stackers awake at night. In the fine print of every futures contract, and in the user agreement of many ETFs and unallocated storage programs, there is a clause. It is a force majeure clause. It essentially says that if the exchange or the custodian cannot source the physical metal due to extraordinary circumstances, they have the right to settle your contract in cash. Imagine this scenario. You bought a futures contract for silver at $100. The price goes to $150. You want to take delivery, you want the metal, but the exchange says, "I'm sorry, we have no metal. Here's your $150 in cash, have a nice day." You made a 50% profit on paper, but when you take that cash to a coin shop to buy real silver, you find that the real price is $200 because of the premiums. You won't be able to buy the same amount of ounces you thought you owned. You have been defaulted on. The flash crash yesterday increases the probability of this scenario. When the price whipsaws this violently, it breaks the logistics of the market. Dealers pull their inventory because they don't know how to price it. Wholesalers stop shipping. The flow of metal stops. And when the flow stops, the paper market becomes a casino with no exit door. You are trapped in the matrix, playing for points that you can never exchange for prizes. We need to discuss the arbitrage gap between the East and the West. This is a technical term, but it is crucial for understanding the structural brokenness of the market. Arbitrage is the practice of buying an asset in one market where it is cheap and selling it in another market where it is expensive. This action usually brings the prices back together. Right now, silver is trading significantly higher in Shanghai than it is in New York or London. In a functioning market, traders would buy millions of ounces in New York, fly them to Shanghai, sell them, and pocket the difference. This would raise the price in New York and lower it in Shanghai until they met. But this gap is persisting. It is staying open. Why? Because you cannot get the metal out of the West fast enough. The friction is too high. The vaults in London are being drained, but the logistics are clogged. This tells us that the flash crash in the Western paper market is irrelevant to the physical reality in the East. The East is consuming silver. They are building solar panels. They are building electronics. They are stockpiling reserves. They do not care if a computer in Chicago decided to sell. They are happy to take the discount. Every time the price crashes in the West, the East drains more metal. We are subsidizing their accumulation. We are selling our strategic assets at a discount because we are spooked by a red line on a chart. I want to talk about the panic friend. We all have one. Maybe you are one. Yesterday, I received a call from a close associate. He is a smart man, successful in business, rational. But yesterday he sounded like a different person. He sounded frantic. A few days ago, when silver was going vertical, he called me asking if he should mortgage his house to buy more. He was in a state of euphoria. He was chasing the parabolic candle. I told him to wait. I told him that trees don't grow to the sky. Yesterday he called me again, but the euphoria was gone. He was in the depths of despair. He asked me, should I sell everything? Is it going to zero? I can't take this pain. This is the psychology of the market. It is a machine designed to extract wealth from the emotional and give it to the disciplined. My friend wanted to buy at the top and sell at the bottom. He was acting on impulse. He was reacting to the pain of the moment rather than the logic of the thesis. This leads us to the strategy of how to buy a dip. There is an old saying on Wall Street, don't catch a falling knife. A falling knife is a market that is crashing vertically. It has momentum. It has weight. If you try to buy the moment it drops, you will get cut. The price will smash through your buy order and keep going. You will be instantly underwater. The correct strategy is to wait for the knife to hit the floor, bounce, and stop vibrating. You want to wait for the market to chop. Chopping is when the price stops going down and starts moving sideways. It is the period of consolidation. It is when the buyers and sellers are fighting it out and the volatility starts to decrease. That is the safe entry point. My friend wanted to be a hero. He wanted to nail the exact bottom. But investing is not about being a hero. It is about being a survivor. If you wait for the stabilization, you might miss the absolute bottom tick. You might pay $1 more. But you have significantly reduced your risk. You have confirmation that the selling pressure is exhausted. We also need to address the AI and power grid narrative. You might wonder what artificial intelligence has to do with the price of silver. The answer is everything. The flash crash yesterday wasn't just in metals, it was in the tech sector too. Why? Because a report surfaced about power grid constraints. AI data centers consume massive amounts of electricity. The grid is struggling to keep up. If the cost of power spikes, or if data centers are denied permits due to grid instability, the growth narrative of the entire tech sector takes a hit. When tech stocks crash, the hedge funds that are leveraged long on tech get margin called. And what do they use to pay the margin call? They sell their liquid assets. They sell their silver. This is the hidden correlation. The fragility of the power grid creates volatility in the stock market, which creates selling pressure in the silver market. It is all connected. But here is the irony. The solution to the power grid problem is more efficient energy transmission and generation. That means solar power. That means electric connectors. That means more silver. So, the very problem that caused the sell-off, energy constraints, is the problem that silver solves. The crash is creating the conditions for the next super spike. The lower the price goes, the less incentive there is to mine, and the worse the shortage becomes. It is a coiled spring being pushed down by a heavy hand. Eventually, the hand gets tired or the spring snaps back. I want to explore the concept of the shakeout. Markets are cruel. They do not want you to be rich. They want to shake you off before the real move happens. A bull market will do everything in its power to convince you to sell. It will bore you to death with sideways action. It will scare you to death with flash crashes. It will make you question your sanity. Yesterday was a shakeout. It was designed to trigger the stop losses of the weak hands. The tourists who arrived last week because they saw a TikTok video about silver getting rich, they are gone. They sold yesterday. They took their loss and went back to crypto or sports betting. Good. We don't need them. The market is now lighter. The leverage has been flushed out. The positions that remain are held by the diamond hands, the believers, the stackers who know that a spot price of $100 or $80 doesn't matter when the currency is mathematically doomed. The foundation is stronger today than it was 2 days ago, precisely because the speculators have been washed away. But let's go deeper. Let's look at the 3 signals that I promised to discuss. These are the indicators that tell us if the storm is over or if we are just in the eye of the hurricane. Signal number 1, the gold to silver ratio. Despite the crash, the ratio is holding steady in the high 40s or low 50s. This is significant. Usually in a crash, silver drops twice as fast as gold and the ratio blows out. The fact that the ratio is stable tells us that gold is also under pressure and that silver is showing relative strength. It is not collapsing against gold. It is collapsing with gold against the dollar. That is a liquidity event, not a silver-specific crisis. Signal number 2, the premiums. I mentioned this earlier, but you have to watch it like a hawk. Go to the online dealers. Look at the buyback price. If the spot price is down, but the dealers are raising their buyback price, it means they are desperate for inventory. It means the paper price is lying. If the spread between the sell price and the buy price narrows, it is bullish. If it widens, it is bearish or indicates extreme stress. Right now, we are seeing premiums hold firm. The physical market is ignoring the paper crash. Signal number 3, the bond market. Watch the 10-year Treasury yield. If yields are spiking while metals are crashing, it confirms the liquidity crunch thesis. It means money is tight. It means the system is breaking. If yields are falling and metals are crashing, that is deflation. We are currently seeing volatile yields. The bond market is confused, and a confused bond market is a dangerous beast. We are navigating through a minefield. The flash crash was one mine. There are others. We have the regulatory mine, the government changing the rules on ownership or taxation. We have the geopolitical mine, a war expanding that disrupts supply chains. We have the technological mine, the failure of the digital exchanges. This is why physical possession is non-negotiable. If you hold your silver in an ETF, you are standing in the minefield. If you hold it in a vault in Switzerland that you have never visited, you are standing in the minefield. If you hold it in your hand, you are standing on solid ground. You have removed the counterparty risk. You have removed the algorithmic risk. Yesterday, the algorithm decided your silver was worth less. But the algorithm cannot come to your house and take your silver. It cannot change the weight of your coins. It can only change the pixels on your screen. You have the power to ignore the pixels. You have the power to reject the valuation of the machine. I want you to think about the long game. We are not playing for this week. We are not playing for this month. We are playing for the end of a monetary cycle. These cycles last 80 to 100 years. We are at the end of the experiment that began in 1971 when Nixon closed the gold window. Since then, the world has run on pure fiat currency. That experiment is failing. The debt is the proof of the failure. The flash crash is just noise in the death rattle of the fiat system. It is a violent spasm of a dying organism. Do not let the spasm scare you. Let's talk about the wealth transfer again. Who bought the dip yesterday? Who stepped in when the price collapsed? It wasn't the retail investor. The retail investor was panic selling. It was the banks. It was the trading desks that triggered the crash in the first place. They pushed the price down to liquidity, filled their buy orders, and are now sitting on a massive position at a lower cost basis. They played you. They used your emotions against you. They know that you feel pain when you see red. They don't feel pain. They just see opportunity. To beat them, you have to become like them. You have to detach. You have to look at a crash and say, thank you for the discount. If you have cash on the sidelines, yesterday was a gift. It was a time machine. It allowed you to go back in time to prices from a few weeks ago and accumulate more ounces. If you didn't have cash, it was a lesson in the importance of liquidity, a lesson in position sizing. If you are losing sleep over this crash, your position is too big. You are over-leveraged or overexposed emotionally. Reduce your position until you can sleep. A stacker who cannot sleep is a stacker who will make a mistake. You need clarity. You need calm. The rumor about the mint is the wild card. If that news breaks officially on Monday, the flash crash will be forgotten instantly. The narrative will shift from market crash to supply crisis. The price will rip higher, leaving the sellers behind. This is the danger of selling. You might sell the bottom tick right before the news that changes everything. Markets love to inflict maximum pain. The maximum pain right now is for the price to crash, shake everyone out, and then rocket to new all-time highs without you. Don't give the market the satisfaction. We are also seeing a crisis of competence in the leadership. The regulators were asleep at the wheel yesterday. The circuit breakers that are supposed to stop these flash crashes didn't work effectively. The system is too complex. It is too fast. The humans have lost control of the machine. This reinforces the case for silver. Silver is simple. It is an element, atomic number 47. It doesn't need a software update. It doesn't need a grid connection. It doesn't need a regulator to tell it what it is worth. It just is. In a complex, fragile world, simplicity is the ultimate sophistication. Simplicity is safety. So as we head into the weekend, what should you do? First, disconnect. Turn off the charts. The market is closed. You can't do anything about it now. Stressing over the weekend won't change the opening price on Sunday night. Go spend time with your family. Remind yourself that true wealth is not just metal. It is health, relationships, and time. Second, audit your strategy. Did you panic yesterday? If yes, why? Write it down. Analyze your emotions. Were you afraid of losing money? Were you afraid of looking stupid? Understand your triggers so you don't pull the trigger on a bad trade next time. Third, prepare for Monday. If the mint rumor is true, Monday will be chaotic. If the mint rumor is false, we might see more downside as the algorithms continue to sell. Have a plan for both scenarios. If it goes up, do nothing. You are already stacked. If it goes down, have your buy orders ready at key support levels. The flash crash of January 2026 will be a footnote in the history books. It will be a blip on the long-term chart. But for those who lived through it, it is a scar. Wear that scar with pride. It means you were in the arena. It means you survived the volatility. The fever has broken. The market has sweat out the toxins of the speculators. Now, the real recovery begins. The healthy growth can resume. Don't let the red candles blind you to the golden future. The debt is still there. The shortage is still there. The world still needs silver, and you still have it. You won the battle yesterday simply by not selling. You held the line. That is a victory. Claim it. And remember, the machine can calculate the price of everything, but it understands the value of nothing. You understand the value. That gives you the edge. Hold fast. The storm is passing. The sun will rise again. And when it does, it will shine on your silver.